Hey everybody, welcome back to the channel. I hope you're doing fantastically well. So today I want to take a quick look at some of the rules for overview funding. Now, as a prop firm, these are ones that I get a lot of comments about, that people don't trust them, don't believe in actual payouts. But I can say from experience, I've had no issues whatsoever actually getting payouts, providing you stick to all of the rules. The rules are quite restrictive and can be a little bit difficult to understand, and there's a bit of confusion, I would say, on what's actually described on their websites of what is actually a rule violation as actually more interpretation of what the rules actually mean. So I thought I'd cover two of the specific rules, that is the martingale trading and hedging, because actually on the dashboard it actually comes up with a violation status. So it almost looks like you're allowed to violate up to 3 times. Personally, I have never violated these rules. I'm aware of what they are and I don't add those to my trading strategies. I don't know enough about the actual processes with the support team to say if you do violate them, would this actually count as a violation and losing the account? So what I want to say is understand the rules and make sure that in your trading strategies and your routines, do not go and make these same mistakes, because you could be at risk of losing your account. So firstly, when you actually go to the website, go to the FAQs, you actually scroll down and look at what trading styles are allowed or not allowed. Now, it does say we welcome all trading styles that can be replicated in live market conditions. Trading styles that are deemed as cheating on demo accounts are not permitted. Below is a list of styles prohibited within our program: gap trading, latency arbitrage, long short arbitrage, reverse opposite account trading, hedging, tick scalping, and martingale trading, grid trading, and news straddling. Although this list does not include all of the tactics that can violate our trading policies, these are the most frequent ones we have observed traders trying to take advantage of in demo accounts. If any account is seen to be using unfair strategies or an unrealistic trading style, their account will be suspended. Now, there used to be a link on the website to the true terms and conditions where everything was detailed, as well as a link to the YouTube video explaining all of the strategies in great detail. Now, I've been through their YouTube video many times and still the strategies are not clear exactly what they mean. And I know some people commented me in the past and they were unsure as well. That's why I'm making this video. So we're looking at a lot of the arbitrage strategies. That for me is not something that most traders will be doing. You need to have a lot of knowledge and a lot of understanding of the markets, and you probably wouldn't be doing that on these type of accounts. For majority traders, they're looking at the hedged and the martingale. Now, the hedging is an odd one because for me, actually, when you look at the exact description on the YouTube video, it really claims that the nature of hedging, as seen by OFP, is whereby a trader buys and sells at the same time at the same price in order to make a profit either direction and limit downsides. But again, that's a slight contradiction to a true hedging strategy, in that, let's say for an example, you have a position that is losing. You believe that's going to turn around at some point, but in the short term, that might go down further. So you take the opposite position. So let's say at the moment we are buying GBP USD. We are looking for that to go up to, let's say, 1.28, and currently we're at 1.26, but price is dropping down 1.257, 1.255. We take a short position because we want to cover some of those losses, and then we are hedging against that, so therefore we are net. Any price movements either direction, we don't actually lose out. We can then close our short for a small profit as price reverses, and then comes all the way back into our profit on our long, and then fall and take our existing take profit target. That to me is a hedging strategy, but again, slightly contradicts what OFP says. I would say if you are in a position that you have an open position, let's say any buy or short on any instrument, do not take the exact opposite position. So let's say you are buying GBP, at no point can you short GBP. If you wanted to do that, you had to close your existing position, take a new position short, close that out, and then take a long. It's also claimed that they will look at any open orders that could be contradictory. So again, if you are in that position that you have an order, do not place it. Make sure you are able to close out manually that trade and therefore open the opposite direction before closing and going back the original direction. Or make sure you have a stop loss in place at some point, close out that trade, and if price does come down even further, then you're able to buy back in at a different position. So again, it's just working out the exact terminology of hedging to make sure you don't get caught out. So the original martingale strategy came out of gambling and betting. So effectively what we would do is if you actually had a losing streak and you lost, the next bet you would place would be double your existing bet. And if you lost that one, you'd double again. So although you're actually doubling and doubling all the way down, eventually you'd get a winning, and that would cover all of your loss and etc. But unfortunately, how Martingale is described by OFP is much more around an averaging down strategy. So if you read their description, it is a trading strategy that sees traders increase their risk size in a losing trade in the hope that when the trade does eventually increase, they will break even or more into profit. So let's take an example where, again, we're buying GBP USD. We are long in that position, but price has gone against us and we are in a negative losing situation. News comes out and it goes down even further, but we see that the long-term fundamentals essentially are still good and we want to buy again at, let's say, 1.25. The reality is we are effectively doubling our risk, but again, we could be going in at a slightly smaller position size or bigger position size. It makes no difference according to the OFP rules. We're essentially averaging down in the hope that that next trade we place will come good. And even if it gets to our original starting point on the first trade, that one closes out for a break even, we've then made the profit on the second trade. Now in a real world situation, what we'd have to do there is, if we wanted to do that, we'd have to close our original trade that was losing, open another trade at a preferred lot size, whether it's double the lots or 1.5, and then wait for that one to come good. If that goes against us and then starts to lose again, we'll close that trade off, open another trade at, let's say, 2.5, 3 lots, depending on what our original entry point was, and therefore hold that trade for a period of time. But as you can see, doing that actually does massively increase the risk and the potential, if it does go against us even further, to lose more money. And that's why they'll say against it is not correct risk management. Now, theoretically, you could be putting a stop loss in, losing no more than 1% on any one of these particular trades. But the reality is we know traders get carried away and they wouldn't actually have that stop loss in place. And before you know it, you're getting close to breaking that 5% maximum daily loss and therefore losing the account. So how do I work around the Martingale strategy? If I do have a trade that is losing, again, I'll go back to GBP USD, but it's overall looking that the dollar itself is getting stronger and therefore having an impact on that one particular pair. What I will do to mitigate that strategy is buy another dollar pair, for an example. So if I was to buy euro dollar, essentially you are assuming that the dollar will weaken and therefore euro dollar will go up. That will often have the same effect that pound dollar will also go up because I go both trading against the dollar, and therefore that allows me to still be able to trade on any particular day if I've got a losing trade on GBP USD and I want to go and buy another currency because things are moving up. So hopefully you can see from these very basic examples I've been able to show, it is definitely possible to work around these two particular rules and not get in too much of a difficulty and still maintain your risk management and keep the accounts. And I would say, if you are in any doubt about the rules, please go and talk with the support teams, go to Discord and have a real in-depth conversation with them there, because they'll be able to reiterate the rules a lot clearer than me. I've only gone by what's on their website, what's on their YouTube videos, and what I've personally experienced in trading the accounts over many, many months, where I've not violated any of these rules and I've not been banned because of it. So that's been really insightful, and if you are looking to go with OFP, there are some great discounts over there right now, so hopefully go and sign up, take some profits, and then enjoy spending them. So thanks for watching today, and I'll catch you again very soon. Cheers!